Is it time for people, like, let's say you're somebody who was on the sidelines for this rally, you know how bad it is out there in parts of the country. What do you do now? Do you chase this market? Do you wait for kind of the pullback opportunity that Jim's talking about?
Well, I think if you're talking about 5%, no. I mean, because that means virtually nothing. That could happen in a day or two, and then you're just, trying to time a 5% pullback is beyond a fool's errand, I think, for anybody who's got a disciplined long-term plan. Having said that, I went and looked for some analogs that might mirror the situation that we're in, Kelly. And, most people probably don't know this, but from 1932, when the stock market bottomed at the depths of the Great Depression, to 1937, the stock market tripled, even as Main Street was suffering as dramatically as it was. And I think it's an imperfect analog, but I think this divergence between Main Street and Wall Street is becoming more pronounced. So, with respect to the stock market, given the favorable liquidity conditions, given that the vaccine's out there, fiscal stimulus or relief is coming in some form or another, the stock market's going to do what it's going to do, but we're going to see some permanent long-term damage to Main Street. 28 to 31% of small businesses in New Jersey alone are either out of business or going out of business permanently. So you can extrapolate that around the country. 54 million people, or 15% of the population, facing food insecurity. So I think this divergence between the two streets, they're not intersecting, they're not running parallel. In fact, one has taken one fork in the road and the other one's landed right on the prong. So, I think it's really wildly different stories in both places.
Ron, two things I would say to that, because on the one hand, it's a lot of Main Street that's been buying the market since the lows, and in many ways outperforming the hedge funds. We've been talking a lot about how it's retail investors. I mean, in some ways, they are the ones who see through this to the other side. The other interesting thing going on is that for as many businesses as there have been closing up, there has also been a big boom in startups. And so in some ways, this is the acceleration of change in an economy, maybe over what's usually spread out over a much longer term period. The market is clearly looking through to the other side of that. Why shouldn't other investors, who are kind of weighing what to do right now, be doing the same thing?
Oh, I'm not saying that they shouldn't. Now, let me take the day traders, as Bob Pisani was discussing earlier, out of that equation. Look, at some point, they're going to pay a price for a lack of experience and potentially a lack of knowledge, whether they're trading options or, day trading individual stocks. But like I said, if you have a longer-term discipline, I'm not terribly worried about the stock market. With respect to what you're saying about the economy and entrepreneurial activity and startups, creative destruction, while positive for the U.S. economy over the course of its history, also leaves people behind. And as Steve was discussing, being removed from the labor force and seeing an erosion of skills will be an issue for people going forward. If we saw the same pace of job creation this month for the next 4 years, it would take that long to get back to full employment. So creative destruction comes with some pain, even if on balance, it's a net positive for the economy.
Shepard Smith here. Thanks for watching CNBC on YouTube.